is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Iga Hallberg, Business Development Lead at EV Realty, a company that develops, deploys, and operates grid-ready charging hubs for commercial fleets. With prior roles at Gauge, Zero, and mentoring work in the Texas innovation ecosystem, Iga is on the front lines of partnerships that accelerate fleet electrification. Iga, thank you for joining us.
Yeah, thank you. My pleasure, Hall.
Good. So where are you calling from today?
Lovely Austin, Texas.
That's a great place to be.
Great place to be.
So, today we're going to discuss, electric vehicles and charging mobility. Can you tell us about your recent experience in this space?
Yeah, I'd be happy to. So Gauge Zero, the company that we started in Austin late 2022, early 2023, was an owner and developer and operator of commercial vehicle charging hubs. We launched the company with the leadership having a significant background from renewable energy development projects. And we were quite excited about a shift in the industry supporting a business model around energy as a service. So in essence, we developed, we owned, and we operated charging hubs. So imagine sort of sophisticated fueling stations for commercial electric vehicles. We're backed by a large private equity firm with a $300 million commitment to develop a network of these sites all over the country, with a primary focus in California, Washington, New York, New Jersey, and we did a number of really interesting projects in Texas that I'll be happy to talk about. I headed up business development for the company. Earlier this year, we partnered with a company called EV Realty, and they are California-based, also developing large hubs especially in support of commercial vehicle transition. We're going to spend a lot more time talking about that, why that's such a significant business model and what's happening in the industry to drive that. And we're in the middle of a transition actually to shift all of our projects to EV Realty. So I'll be talking about the commercial space as far as electrification, and then would love to, just because of the obviously broad network of investors that are part of your community, I'd love to touch on what's going on as far as private vehicles and light duty and opportunities for investors actually to take advantage of some of the work that's being done in charging for that segment as well.
Great. Let's dive in. So
Awesome.
What is the investable thesis for charging infrastructure today? I mean, today, not 5 years from now.
Yeah, so the big trend that has actually happened, especially with a significant, shift in interest from commercial fleets, and when I'm talking about commercial fleets, I'm really discussing Amazon last mile delivery, Amazon Freight, FedEx, Walmart, large, both last mile delivery, so vans, but also Class 8 vehicles. So the primary push in electrifying that sector has been around very large, dense areas and ports predominantly. So what we have seen in the last 5 years is a big push from Southern California ports of LA and Long Beach, to electrify a segment of that freight market called drayage. And so as the ships come into the ports, they are removing containers. The containers are placed on the back of the truck. Those are drayage trucks. Those tend to be very old, and so probably considered the most polluting out of all the commercial vehicles. They tend to also have very short runs. So they go from the port to the distribution center, drop off a container, go back to the port, pick up a container. So they do fairly short runs, which actually fits some of the technology for electric trucks right now that don't have the 600 miles on a full tank, for example, that you would expect to see on long haul. So that drayage application has been the first one that has really triggered that shift. And then companies like Amazon and FedEx have had a pretty significant an ambitious plan to significantly reduce their carbon footprint, especially on the freight side. And they have been, Amazon to date has the largest fleet of electric vehicles. I'm sure you see them, delivering with their Rivian trucks that kind of look the same as the other Amazon trucks, but have a little bit of a different shape. That's been a very successful program for last mile delivery there.
Great. Well, what's the single trait that makes a charging hub feel like an infrastructure asset rather than a pilot?
Yeah, no, that's a really great question. So the whole charging hub concept got launched about 3-4 years ago. I think I mentioned when I introduced myself that our company, our leadership came from large renewable energy development, infrastructure development. It's the same case for other large companies in this space that have received significant funding. That's Forum Mobility, Volterra. There are a number of other companies in our space. All of them are backed by private equity. And what has happened is that private equity, much more so even than venture capital, though there's been both, have been investing in this new asset class around infrastructure and structuring these energy service contracts for customers that are very similar to what would be considered in the industry as a power purchase agreement that we have seen in the solar and wind industry for the past 20 years. So in essence, you're having, an investable project that is taking advantage of incentives, tax credits, and financing these projects for, 20 years. And what's the appeal from an investor standpoint are confirmed contracts, take or pay contracts that are usually multi-year. So imagine, for example, if we own and operate a large charging hub, we're selling a contract to, let's say, again, this is, theoretical for a point of example, to a Walmart or an Amazon to charge their vehicles in our hubs. And that's a very financeable project from an investor standpoint. So that's really what's triggered this concept of these large hubs that are owned by third parties, that are shared hubs. There are usually large multi-acre, multi-megawatt type of projects.
So when people compare charging to renewables or data centers, where does that analogy help and where does it mislead?
Yeah, so I think the first and obvious is the fact that this business model was actually created in renewable energy. And so it's the same if you're familiar with investing in any of the data centers, storage, renewable energy project. The appeal from an investor standpoint is that commercial agreement, that contract. So that's what is being banked, right? And then there are multiple layers of financing and financial structures that then make these projects quite appealing from a long-term NPV perspective. And, where, for example, where it's misled is that the industry is probably not as sophisticated as where we were with the solar industry and wind industry to be able to really do that at this massive scale. And so the industry is adjusting a little bit right now. There are changes as far as, how these projects are financed, and with changes in, federal policy, state policy, incentives, both at a federal level and state level, all of that is shifting right now.
Okay. Well, walk us through the main models you see in the market. There are real estate first developers, there's operator-led networks and utility-anchored approaches. Who takes power risk and who takes utilization ramp risk in each of those stages?
Yeah, no, super, super interesting question. So I think we've covered the heavy duty commercial sector, and I think it's just to point out to why that's so interesting in Southern California and in other urban areas. There's, limited access to power. We know what's happening in California right now. There's a lot of grid congestion. It's very difficult to find multi-megawatts of available power. So let's say, again, loving the example of an Amazon, if you have a lot of distribution centers all over Southern California, in some cases, your site just does not have any more additional capacity to be able to charge 50 Rivian trucks. So that's where it becomes beneficial to go to a third party, even if it's, 2 blocks from your distribution center, a mile down the road, but has confirmed power. So it's all around power and power access. And dense areas, New York, New Jersey, around the ports, even Washington in some cases, We don't have that as much in Texas, but other markets absolutely feel that grid constraint. So it's created an opportunity for third-party owners to come in and provide charging as a service. It's very different if you are, for an example, an investor in commercial office space, or you have multifamily residence, for an example. And let's say we use the case that we are now in Austin, Texas, or you are in Houston, or you're in Dallas. One, it's a very different utility market. Two, we have a lot more capacity on the grid. And then from a standpoint of demand, we now have a lot more experience and insight into how people charge their vehicles, whether that's a, passenger vehicle or a light duty vehicle. So what we have seen is, and it's interesting to use the expression that's real estate investor first, is because we see investors that own, let's say, multi-residential projects and housing as investing in infrastructure and mobility infrastructure as a strategic investment for their tenants, right? So let's say if I am looking for an apartment that I need to rent and I have an electric vehicle, obviously I'm going to look for places where I can charge it close to my home. So it's important for me to be able to live in a place where there is charging available. And so it creates an opportunity for investors to differentiate, right? And there are opportunities also both on a commercial and residential segment to look at ways to do a revenue share. The risk lies on who owns the actual chargers, because you need to operate them and you have to figure out a way how to plan for that demand. So the more you can de-risk it by anticipating the demand through contracts, through commitments, through, reservations, if it's a commercial or a residential, facility, the more you de-risk that.
Okay. Well, where has each model actually won on the ground and where has it struggled? Give us an example of a model to avoid for a specific use case and why.
Yeah, the biggest issue is no matter where, again, and I'll just because of the audience here that is most likely more interested in their own, for example, investments, it's this really question about how do you take advantage of putting in the infrastructure without having to put up that much capital. So there are now a number of companies that are coming in with services specifically designed to offer charging and mobility to owners of multifamily residences, for example, or even small restaurants, chain of office buildings. So it's more and more becoming, it's more common now to put in infrastructure without having to put up the upfront capital. And then it's creating other opportunities for revenue share and other ways to market and offer those services.
Right. Well, if I look at last mile delivery, rideshare, school buses, heavy duty depots, how do differences in dwell time and load profile change the way you design and underwrite a site?
Yeah, so going back to the commercial side, and schools are a little bit different. They're probably in theory the most predictable as far as, their charging behavior, because buses run from 6:30 a.m. to 9 a.m. or 9:30 a.m. and then run again from, let's say, 2 o'clock until 5 o'clock. And so that what we consider dwell time is when those buses are sitting there not being used, is a great time for them to be charging. So there are a number of companies that are looking at really innovative models around potentially even charging those batteries, discharging them. So there's concept of vehicle to grid. So not just pulling from, but then discharging back to the grid in cases of, blackouts. And so the schools and school buses, there are companies that just specialize in that space. There's a whole class of companies that just work with that segment. For, the rest of us that are doing things like the rideshare is actually a really interesting example, because we now in Austin are one of the largest markets for rideshare companies, and we have been testing actually rideshare technology, autonomous technology here in Austin. And there are now multiple companies that are just focused on rideshare. And the idea is that you want to be able to bring those cars back to that site, charge them as fast as possible, and get them back going again. So there are situations where those cars are sitting there for a few hours in the middle of the night, but for the most part, you want fast charging. Typically, that can happen during the day. And sometimes that's also during prime, day and time of day pricing, depending on the market that you're operating in. And so there are premiums for charging depending on how fast you want to be charged and what time of the day that you are charging. So it's really quite interesting, and it's a similar situation with last mile delivery, although most of the vehicles will charge when they are down. Let's say at the end of a shift, the Amazon truck goes back to their own hub. They are plugged in, they're getting ready, they clean out the van, bring in all the new packaging to be delivered first thing in the morning when that truck goes back out. So that's typical different behaviors that we see from a dwell perspective.
I see. So which segment is the most financeable today, and which one is the most operationally painful but still worth the effort?
So we know, we've known the residential charging, I should say, for passenger vehicles. We have the most history with that. And historically, the companies that have been in that space, ChargePoint, Blink, and well-known names, it has been very difficult to plan and make good returns on those projects because they're public facing. You just don't know when somebody's going to pull into your local grocery store and charge in their car. It's unusual, right? We know that, other stores have done that. IKEA has done this. Walmart has done this. So there are more and more retail stores and businesses that have been doing this, but it's very difficult for them to make money off of this. It's very unpredictable charging behavior. And so they do it as a strategic incentive. It's not necessarily a money-making project. Where we see more, and that's why I think the whole category of private equity backing into large hubs is because you can actually get some very interesting returns because you have contracts, right? These are take or pay contracts. And then the last, just from an infrastructure standpoint, is there are now a number of companies that are providing different types of incentives that reduce the capital outflow, the initial capital investments. And that's where there are a lot of startups in that area. So you might be actually getting pitched by some of them to raise money. And I think what everybody also, if you're interested in that space, it's de-risking that customer commitment, the take or pay, whatever you can do from a contract standpoint is the main factor in all of this.
Okay. And so what are infrastructure funds and private equity asking for now that they did not ask for 2 years ago?
Yeah, it's contract. It's all about contract.
Okay.
So the more that you can de-risk these projects, the other thing that's happening is as we have in the past 6, 7, 8 months, have gone through significant changes and reduction in investments, incentives. A lot of projects have gotten pulled because IRA funding got canceled. So from a federal standpoint, a lot of incentives that were there to attract a new class of investors are no longer there, have created somewhat risk. So these deals are getting restructured and all of the financing is getting restructured. So we will see how, from a large hub perspective, that will shift. What we're seeing is from a light duty perspective, autonomous vehicles, rideshare, that is all moving forward. And where we see a lot of activity is on the, again, commercial spaces, school campuses, REITs are continuing to invest in infrastructure. And it's just important, and we don't have as much, development period on the commercial end. We don't have as many large logistics centers that are being built as we had maybe 2-3 years ago, sort of post-COVID. But when that starts to uptick again, each and every single company, whether you're, Prologis, JLL, CBRE, all of these big real estate firms have now really built up their energy transition teams, and they are covering everything from what do we need for all of our facilities, from on-site generation, backup power, storage, infrastructure. It's being treated as a whole category now, which is really interesting.
Cool. Well, give us one project that got the mix right on site control, power, and offtake. What was replicable and what was lightning in a bottle?
Yeah, I think, I could pull a number of examples from around ports specifically. And again, it's the ports of LA and Long Beach have been an example in launching a number of electrification projects across the board, everything from cranes to yard goats to trucks that are coming in and out and setting up the infrastructure in order to be able to do that. So the trucks that are coming into the ports can actually charge there, go back to their distribution centers, come back and recharge again. So there are 3 companies now that are doing that at the ports. Gauge Zero was one of the ones that won one of the projects, so we'll see whether that will continue with that transition. But Forum Mobility, Volterra, there's also Prologis Mobility, which is a well-known real estate development name as well, and have been investing heavily around the ports in order to support that. And all of them are, again, if you see these sites are very sophisticated, usually we'll see 20, 30, 40 ports. They can all accommodate large trucks, the cabs themselves, or even with containers. So they're very sophisticated. They have security, they have you can make reservations, right? Because if you're running a haul, you don't want to risk that you pull in and somebody is sitting in your charging site. So it's great examples of how that industry is going to continue to move forward.
So name one decision you would redo on a past site, the lesson you now apply at the LOI stage.
Really great question. I think where we've learned a lot is the kind of customers that we want to work with from the very beginning. And, what the industry is going through quite a bit of change. And because of in many ways, from a heavy duty perspective, the trucks themselves are not quite fully capable of running what a typical diesel truck equivalent is. So, we are spending a lot more time talking to fleets about operations and think of how to, support them. Where I see amazing opportunities, and I love using this example of IKEA, and there's even one locally here in Austin and Round Rock, where the company has now reproduced this model of investing in infrastructure, and they're just partnered, for example, with a company like ChargePoint to be able to provide charging at no charge to their customers that is store facing. And then they have charging in the back that's commercial facing. So they now have a special agreement and a model with a company that basically does a ride share for delivery vehicles that come in there, will be able to provide the driver with instructions where the truck will be already fully loaded, or they have to pull up to the back of the bay, pick up, let's say your couch and your table, and they will bring it to your house, drop it off. So, they're trying to do a lot more with zero emission deliveries and have created a really novel model in order to be able to do that, both for their, store facing customers, but also commercial providers that are doing last mile delivery with zero emission trucks. So great example of, again, a very innovative business model.
And so what is the cleanest partnership structure between a developer, a utility, a real estate owner, and a fleet that cuts corners off the timeline?
Oh, great question. So again, Texas is a little bit different and it's utility by utility specific. We just don't have the constraints on our grid. And these are not the scale of a data center. When we do a large hub, and there was an announcement Gauge Zero made with Hillwood, which is a Perot family development company up in Fort Worth, to put in a large hub at the Alliance, Texas site, which is very important, both from a commercial freight perspective. There's a very large inland port that is, BNSF airport that handles a lot of freight throughout Central Texas. And when we, for example, were working on a project like that, we were looking at a multi-acre site and, interested in the 6, 7, 8 megawatts, a typical data center that we're all very much aware of, especially as hyper growth centers are in the 200 megawatts, 400 megawatts. Now you're hearing about people building, a gigawatt type of a center. So just the scale and the sheer size of the power that's required is a little bit different. So we don't have as much of an issue as far as constraint. But in California, we would have multiple examples, even in New Jersey, where we've gone through the application process to pick a site. You wait 3 months and you find out that you don't have power there and you're starting from scratch. So just from a standpoint, your relationship with the utility has to be very tight, very collaborative. The more insight we have into the grid health in that site, for an example, that neighborhood, that city, you prioritize certain locations by power that is available that doesn't have to be upgraded. And that's one of the things that actually my current company, EV Realty, does. And that's why they call them powered properties, is because those sites are confirmed power and are in critical freight locations, distribution locations. So power is very important, visibility into what's going on with the utility, where there is available power. The developer owns all of that. It's on us to figure that out. And, when you have delays because you don't have, very often we'd be looking for locations in California. We're told by Southern California Electric that it's 5 years for the upgrades in that site. So, that's a major issue, right? When you're starting to think about where you want to invest. Likewise, with commercial properties, if you're a developer and you're building, large logistics centers, you have to plan for that. You have to know that that's going to be something that if you're trying to attract an Amazon or a Walmart, they're going to need power in that site, whether it's for infrastructure or for something else. Power is a major, major, major issue for all of us as we look at infrastructure.
Well, interconnection, tariffs and demand charges, managed charging software, and on-site storage. Rank these in orders of impact on returns in the first 3 years and tell us why.
Yeah. Oh, gosh, really good question. So the interconnection, you want to look for properties that have access, as we've already mentioned, have access to power without upgrades. If you have to invest $200,000-$300,000 for upgrades, it's really affecting your returns. Tariffs are a major issue, and quite frankly, benefit in helping just create demand. So market movement, both on the vehicle side, on the charger side as well. In California, even though a lot of those changes in support and in both on the incentive side and the tax side, have gone away to a certain degree, there are other market potential, financial programs that are interesting, like low carbon fuel standards. So, projects are moving forward. They're just being financed a little bit differently or with different type of a structure. The demand charges are a major, major issue in how they impact your economics. If you are infrastructure owner and developer, you could pass those through to your customer, right? So let's say if your fleet is coming in and they're pulling in at 4 o'clock, your customer is pulling in, you can actually flag to them, look, you're going to be paying 50 cents per kilowatt hour now. If you wait until 9 p.m. or 10 p.m., you're going to spend 25 cents per kilowatt hour. So there's a behavior change, and that's where the software actually comes in, where that is very helpful if you know that that vehicle is going to be sitting there. And again, that's across the board. That's for passenger vehicles and commercial vehicles. You can actually manage those demand charges. I happen to have an electric car and I'm in Austin, so it doesn't matter. I don't have demand charges per se, but I know that if I plug in at 11 o'clock at night, I'm getting power from West Texas, probably from wind. Hopefully it's a little bit cleaner, so that, and I don't need it to charge at 8 o'clock at night. I can wait until, 11, and it doesn't make a difference for me. But if I'm running a route and I'm pulling in at 4 o'clock and I need to turn around and do deliveries at 5, I'm stuck with paying demand charges.
Where's the real demand curve steepening over the next 24 months? Is it school districts, rideshare platforms, last mile, or Class 8 corridors?
Yeah, school districts are moving forward because those are all state incentives. And that money has been set aside for each and every single one. In Texas, we have a really robust program for schools and even for commercial vehicles. I know Environmental Defense Fund has been fighting really hard to put money aside there. I would say that rideshare platforms are becoming just very popular. And so we see really a big growth in that segment. And companies, even in our space that we're focused on, heavy duty commercial, have shifted to light duty. So that market actually is going to continue to grow. I mean, everybody's talking about what's happening with robotaxi and so on, Zooks. So I would say those two segments are very much moving forward.
Right. So, which policy or incentive most credibly de-risk private capital right now, and which one is overhyped?
Yeah, good point. So, where the industry has been really relying has been the tax credits because they've made such a big impact on the returns on those projects. And so there is quite a bit of shift. There's still some time that we can put a lot of these projects in the ground before really those incentives start to go away. The big push right now in the industry is just to reduce cost as quickly as possible because these electric vehicles are still more expensive than their diesel. equivalent. And so there's just this massive focus on cost reduction.
Hmm. So place charging hubs in the larger system. How should investors think about the interaction with renewable storage and other distributed resources over the next 5 years?
Yeah, the hubs, the third-party charging infrastructure is a great example of a model that's going to probably, be available to all the different segments. I think investors, if you are an institutional investor, if you're looking for a large type of project, there are opportunities to come in and do those as a private investor or as part of a fund. There is ongoing demand and expectations, obviously, for transition in this space. Where I think it's really interesting is for small commercial, light duty, and residential, for investors to take a really hard look at what they can do to create an opportunity and make a strategic service for their customers.
So you have to pick one variable in a new market: power availability, anchor customer, or tariff structure. Which one wins and why?
Yeah, customer, no doubt, right? If you can lock in customers and get demand, it's the first and best way to de-risk a project.
Hmm.
The tariffs and power availability. I guess well, if you don't have power, you don't have a project. But I'm just presuming, let's say, for example, that's solved first. But anchor customers are going to be able to sort of outweigh everything else at this stage.
That's great. Well, in the last few minutes that we have here, what else should we cover and why?
Yeah, I think this is a really interesting space. I look at the fact that the industry is adopting this business model, energy as a service, infrastructure as a service, and it's impacting just all of the energy segments. We've seen it in renewables for the past 20 years. We're starting to see that with storage, with batteries. We are seeing it as actually offering as a bundled service. So companies are, again, I'm thinking, for an example, if I own commercial real estate, it's not on me anymore to have to put up the capital to put in infrastructure. I can actually partner with somebody that's coming in that's got a solution that will take care of it, manage infrastructure, whether that's solar, battery storage, and I just pay a monthly fee, which is pretty great. So you don't have to worry about it. And then all you have to figure out is, how do you market that to your customers, to your tenants, et cetera. So I think the whole energy as a service is a category that's really interesting that, we should definitely be spending some time looking at.
Great. So how best for listeners to get back in touch with you?
Yeah, I'm available obviously through LinkedIn, through the portal, through introductions through you. So happy to be a resource. As I said, I'm still very much involved with EV Realty. I also do advisory work for startups and interested in climate tech, but this space around energy transition is particularly interesting to me.
Great. We'll put your contact details in the show notes. We want to thank you for joining us today, and we hope you have you back for a follow-up soon.
That was great. Really enjoyed it. Thank you so much for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.